Hey there, investing iguanas. Iggy here, and today we're diving into the world of active ETFs, the latest buzz in the investing landscape. Are they really the smarter way to invest? The Investing Iguana is featured and ranked 8th in the 2023 Influential Tigers by Tiger Brokers, with a total of 410,000 reads. In this video, I'll be breaking down everything you need to know about active ETFs, including how they differ from passive ETFs, their potential advantages and disadvantages, and whether they deserve a spot in your investment portfolio. We'll also take a closer look at Singapore's first active ETF, the Lion Nomura Japan Active ETF, AI-powered, which was listed on January 31, 2024. This is a fantastic opportunity for investors looking to gain exposure to Japanese companies with long-term growth potential. So, grab a notepad and pen, because you won't want to miss a single detail. First off, what exactly are active ETFs? At their core, ETFs are investment funds that are traded on stock exchanges, much like individual stocks. They are designed to track the performance of a specific index, sector, commodity, or asset class. They offer a way for investors to diversify their portfolios without having to buy each individual security. Now, let's introduce a variation of the traditional ETFs, the active ETFs. These are not merely passive trackers of an index. Instead, they are managed by a dedicated team of investment professionals who actively make decisions about which securities to include in the fund. Their goal is not just to mirror the market, but to outperform it. This active management involves researching and analyzing market trends, economic data, and company fundamentals to make informed investment decisions. The team might decide to invest in securities that are undervalued or have high growth potential. They might also adjust the fund's holdings in response to changes in market conditions or economic indicators. The aim of these active ETFs is to generate higher returns than those of the market or the index they might otherwise track. This potential for higher returns can make active ETFs an attractive investment option for those willing to take on a bit more risk. However, it's important to note that with the potential for higher returns comes higher risk. Active ETFs are subject to the decisions of their managers, who, despite their expertise and best efforts, may not always make winning picks. Additionally, active ETFs often have higher fees than their passive counterparts due to the additional resources required for active management. Now, you might be thinking, how are active ETFs different from the passive ETFs we know and love? Well, passive ETFs just follow an index, like the S&P Wink with tongue sticking out 500, without any fancy strategies. Active ETFs, on the other hand, have managers who use their expertise to pick and choose investments they think will outperform. It's like having a personal chef for your investments, but without the delicious food. Active ETFs and passive ETFs differ in several key aspects. While passive ETFs simply track a specific market index, like the S&P Wink with tongue sticking out 500, with the goal of replicating its performance, active ETFs are actively managed by investment professionals who use various strategies to outperform the market. This active management style comes with higher expense ratios compared to passive ETFs, which typically have lower fees due to less management intervention. The performance goals also differ, with active ETFs aiming to beat the market or benchmark, albeit with higher risks, while passive ETFs aim to match the performance of the index, providing more predictable returns that mirror the risk and return of the index. Additionally, active ETFs may have less frequent disclosure of holdings, resulting in lower transparency compared to passive ETFs, which typically offer higher transparency in their holdings. When considering an investment in an active ETF, there are several key factors that you should take into account to ensure that it aligns with your financial goals and risk tolerance. Firstly, it's crucial to understand the fund's investment objective. This refers to the fund's stated aim or goal, such as capital appreciation, income generation, or a combination of both. You should ensure that this objective aligns with your own investment goals. For instance, if you're looking for long-term growth, you might opt for a fund that focuses on capital appreciation. On the other hand, if you're seeking regular income, a fund that prioritizes dividend-paying stocks could be a better fit. Secondly, consider the track record of the fund manager. A fund manager with a history of strong performance could be a positive sign, but past performance is not a guarantee of future results. It's also important to consider the manager's investment style and philosophy to ensure it aligns with your own approach to investing. Thirdly, don't overlook the fees. Active ETFs typically have higher expense ratios than passive ETFs due to the costs associated with active management. These fees can eat into your returns over time, so it's important to factor them into your decision. Be sure to compare the fees of different active ETFs to ensure you're getting a good deal. Lastly, compare the ETF's performance to relevant benchmarks. This could be a broad market index like the S&P Wink with tongue sticking out 500, or a more specific index that reflects the fund's investment focus. Comparing the fund's performance to a benchmark can give you an idea of how well the fund is doing relative to the market or its peers. Introducing the Lion Nomura Japan Active ETF, powered by AI, Singapore's first actively managed ETF and the nation's pioneer in AI-powered investing. As a disclaimer, Iggy is not paid or endorses this ETF, but is merely using this as the first example of managed ETF in Singapore. This innovative fund combines the expertise of two industry giants, Lion Global Investors and Nomura Asset Management, to bring you a cutting-edge investment solution. The fund managers at Lion Global Investors and Nomura Asset Management have developed proprietary AI and machine learning models that analyze hundreds of factors to identify hidden gems in the Japanese market. These AI models work faster than humans and are updated monthly, allowing the fund to adapt quickly to changing market conditions. By combining active management with cutting-edge technology, the Lion Nomura Japan Active ETF seeks to outperform its benchmark, the Tokyo Stock Price Index, TOPIX, and provide investors with exposure to quality Japanese stocks with long-term growth prospects. It's like having a team of super-intelligent robots working around the clock to find the best investment opportunities for you. In conclusion, active ETFs present an exciting new opportunity for investors looking to potentially outperform the market. By combining the benefits of professional management with the flexibility and transparency of traditional ETFs, active ETFs offer a unique investment vehicle that could help you achieve your financial goals. However, it's crucial to carefully consider factors such as expense ratios, manager track records, and investment objectives before making any decisions. If you found this video informative and valuable, please give it a like and subscribe to the Investing Iguanas channel. By subscribing, you'll ensure that you never miss out on future content designed to help you navigate the complex world of investing. If you have any questions, thoughts, or suggestions for future topics, please leave them in the comments section below. I'm always eager to engage with my audience and provide the most relevant and helpful content possible. Remember, investing is a journey, and the key to success lies in continual learning and adapting to new opportunities. With the right knowledge and strategies, you can make well-informed decisions that align with your financial objectives. Thank you for joining me today, and I look forward to sharing more insights with you in the future. Until next time, stay curious, stay informed, and keep investing wisely.